All right. We are now looking at reviewing assignment 5. So we're looking at reviewing assignment 5. And in reviewing assignment 5, you'll see that assignment 5 had a bit of theory questions. Assignment 5 had a bit of theory questions based on a case study of Offices Limited. So assignment 5 had a bit of theory questions based on the case study of Offices Limited. I'll just give you a minute to just quickly brush through this particular case study. Can you just quickly brush through this case study in a minute? So they tell us that the company has 200 million in shares. The share price is 30 cents. They give us the assets, the liabilities, and equity. And they give us the earnings before interest and tax, the interest expense, the tax rate, the beta, the risk-free rate, and the market risk premium. Then they also go on to say the company has had to incur a lot of debt to stay afloat and is planning a rights issue to raise funds to repay some of its debts and to implement its turnaround plan. Management estimates that it needs 20 million over and above any retained earnings to implement the turnaround plan, while they wish to lower its debt by 50 million to bring about better profitability due to reduced interest payments, together with more future flexibility. So it is not expected that the EBIT would change for the foreseeable future and that any effect on the turnaround plan would only be felt later. The company will immediately use 50 million to retire debt to that amount, and while the 20 million for this turnaround plan will be kept in cash initially. So the interest payments are expected to fall proportionally with the reduction in the debt amount. So for part A of the question, they say, if a company changes its capital structure, what would you expect would happen to its risk profile and the return it is expected to generate? Now, please check in your assignments. Remember, this part A was out of 8 marks. Roughly, how much did you guys get? Because I haven't seen the feedback on any of the students regarding this part of the theory questions. In the meantime, if you check on the lecturer's feedback regarding part A of the question, if you check on the lecturer's feedback regarding part A of the question, so on the lecturer's feedback, the lecturer says you can appeal your assignment mark based off clear and significant incorrect marking, while some of the minor violation in marking is always possible due to the slightly subjective nature of the process. A clear discrepancy would be reasonable basis to appeal. So you can appeal your mark until the $12. Then they say, please note the following process for doing so. Compare your answers to the solution. If you find significant discrepancy, note it. Check that discrepancy against the solution comments on the mark and the mark allocation for the question. For example, if in question 1, which was worth 33 marks, you missed 1 mark in the evaluation. It may be that in the discussion, your argument could be slightly better, and the mark is indicating of what the marker thought your answer deserved based on the marking guidelines. So if, however, you've had correct calculations in question 2 exactly in the memorandum, but you only received 0 marks, you should contact me so that it can be rectified. Then they also gave those other notes as well. And then they also go on to say, some general notes I want to make after considering the marking process as a whole. Before we delve into the solutions, I want to address the few general issues I noticed among your assignments. And yes, these are just generalized comments, and you may not apply to your answers, but for others, they may be useful to improve the future. In future, to please consider the comments as they apply to your situation. The first comment was, during the examination, you'll be using both the 10-it and the invigilator application. So please be mindful thereof. So the 10-it, it reports from many students indicated the high similarity index. So in the examination, high similarity index will be evaluated, and if there is any indication of dishonesty, such cases will be referred to the disciplinary hearing. Please note the outcomes of such hearings range from registration, module sanction, and all those other things as well. Then they say if your 10-it score was problematic, it would have a short comment from me. So this serves as a warning so that you can count as extra evidence on the inflation app as well. So they talk about that and that and that as well. Then when you look at question number 1, they say your answer should have incorporated the relationship between risk and return and the impact of interest payments changing over have on profits. So the leverage effect should have been discussed, and also changes to ownership or dilution should have been discussed as well. So this is what was expected to be discussed when it comes to part A of question number 1. Is the when you look at part A of question number 1, what was your feedback from the lecturer? What was the feedback from the lecturer regarding part A of question number 1? Remember, in our analysis of part A of number 1, we said the change in capital structure by increasing debt results in increase in financial risk due to the increase in fixed obligation of interest and principal amount when they fall due. Up to the optimal level, holding everything else remaining the same, the cost of debt is generally less than the cost of equity. Hence, the return generated might increase as shown by the return on equity and the earnings per share. If debt is decreased, the financial risk of the firm is expected to decrease. And if there's a less fixed obligation on interest and principal amount when they fall due, then if the decrease in debt is financed by an issue of ordinary shares, holding everything else remains the same, profitability might decrease due to the increase in equity and the number of issued shares as shown by the return on equity and earnings per share. So when the change in capital structure is due to the increase in equity, financial risk is expected to decline as equity has no fixed obligations and equity holders get a share of the profit that remains after all other stakeholders have been satisfied. So increase in equity might lower returns as there is no leverage effect that's dilution of profits due to increase in the number of shares. And a decrease in equity, if financed by issue of more debt, may increase profitability due to leverage effect of using financing structure, which is generally less than the cost of equity up to an optimal capital structure. However, the decrease in equity, if financed by issuing debt, is expected to increase financial risk due to the increase in use of fixed cost financing, which would be the burden to the firm during the periods of financial distress. So those are some of the issues that they expected us to discuss. Remember, they asked us to discuss the effect on financial risk, They ask us to discuss the effects on profitability, and they also ask us to discuss the issue of dilution of ownership as well, which means that the dilution of ownership is where there's an increase in share. The moment we issue more ordinary shares through a rights issue, we would expect that if the existing shareholders don't take up the rights, what is going to happen? There's going to be dilution of ownership as well. So what was the general feedback? Was there any general feedback given on your individual assignments when it comes to part A of question number 1?
I got 7 marks out of 8, but there was no comment, so I'm not sure what was missing. Obviously, I used my own language, not the way we did it in class.
Okay.
I don't know, maybe there's something in the
All right.
wording.
So what I would say is, if you got anything below, say, 5, if you get anything below 5, let me know so that I can also individually review that part of the assignment and see what was your wording and what was your language and exactly what was did we get, what was expected from the lecturer as well. So after the class, if you got anything below 5, please let me know so that we can review to see if what went wrong in answering that question. All right. Part B of the assignment, they were saying, consider the case above. What capital structure theory or combination of theories as described in chapter 14 is evident in the case? Argue your case at the end of the description of your textbook, but do so in your own words. So they ask us to discuss the theory that we are seeing that is being discussed in this case. Remember, we're looking at the theory where you look at considering where we are saying that we have been going through issuing a lot of debt, but now we are now considering what having a rights issue so that we reduce the amount of debt in that case as well. So how we answered this question for part B is that we said on the memo, so on the memo that we shared with you, I said the theory would be the trade-off theory. So the changes in capital structure involve a trade-off between risk and return as shown by the intended retiring of debt through a rights issue. Then there's also the issue of financial flexibility, where they say, in order to increase its future borrowing capacity, a firm may retire some of its debt so that the future of the so that in the future, if they need debt, they will be over indebted, and also in case of economic downturns, which may lead to financial distress, the company would be able to survive when they reduce the debt amount as well. So for part B, you'll see that on the lecturer's feedback, the lecturer said for part B, the most correct single theory to mention was the trade-off theory, which is the one that we mentioned. An argument is that vain or for multiple theories would also have garnered marks, while an answer indicating another theory in a well-substantiated manner would have received some marks as well. So which means the main theory, as we discussed there, was the trade-off theory. Then moving on to the next question.
Hi,
Yep.
sir. I'm so sorry to disturb you. I just wanted to, because on the memo, they don't quite elaborate on the answer as much as you did. I don't have time to write everything down. Can you just kind of go back to the page just for question A, so I can just maybe screenshot it so I can get a recording of it?
Okay.
Please.
Okay.
Thank you.
What I would do is I'll also share I'll also share the memos that I made as well on the Google Drive, so that when you under assignment memos for 2024, you will be able to access all the assignments, the lecturer's memo and the memos that I prepared, so that you're able to make a comparison. I'll try to make that available so that you're able to see in detail what the discussion was.
Okay, thank you.
Right. If you don't get it by Wednesday, on the Google Drive, please let me know so that I remember to upload it as well in case there are other things that made me forget as well. For part C of the question, they say, in terms of the behavioral finance perspective, argue whether there is over or under optimism from the management in the case and briefly discuss how this may affect the capital structure decision. Now, when you look at our memo, we said as part of the turnaround strategy, management intends to do a rights issue to raise the required capital. Investors generally attribute a rights issue as a signal that the firm's share is overvalued, hence indicating under optimism from the management. So as a result, the capital structure is expected to tilt towards equity. Then if you check on the lecturer's feedback, they say the correct answer is over-optimism, and an explanation was required for full marks. A reasonable discussion indicating under-optimism would have received some marks as well. So it's either way, it all depends on exactly how you substantiate your answer there. Remember, this was a 3-mark question. So if you got anything less than 2 marks, let me know so that we can review this question as well. So for this particular question, if you got anything less than 2 marks, let me know so that we can review this particular question. Are we together then? On the next question, they say, determine the amount of funding that the company requires and the number of rights the company will have to issue if it is assumed that the transaction and related cost amounts to 10% of the value of each rights issued, while it is expected that the rights issue will be fully taken up and the price of the rights is set at 25 cents. So the price of the rights issue is 25 cents and the cost of issuing or transaction cost in this case is 10%. And then on the question, remember they tell us that we need to raise 50 million to retire the debt. Then we also need to raise another 20 million, for us to be able to now pursue the turnaround strategy. So we need to raise 50 million to retire the debt, and then we need to raise another 20 million to pursue the turnaround strategy. So with that in mind, it means now when you look at the rights issue, we're going to say the total funding required would be 50 million plus 20 million, which gives you 70 million. Then the transaction and related costs are 10% of the price of the rights issue, which is 25 cents, which is 0.25 rand. So the price, the transaction related cost in this case is going to be 0.025, which means that the number of rights issued is going to be total funding required of 70 million divided by the price minus transaction cost. So you will see that the number of rights issued in this case is going to be equal to an amount of 311,111,111. So that would be the number of the rights issued. Are we on the same page there? Any questions? Now, for part D of the question, if you check with what the lecturer mentioned for part D of the question, you will see that on the lecturer's memo for part D of the question, they say the company requires 50 million plus 20 million, which is 70 million. And then they said the transaction costs are 10%. So which means in this case, the company is going to be raising 90%, because remember from the 10%, from the 100% of the funding, they are going to be paying 10% in what? In transaction costs. So which means the company is going to be raising 90% of the 25 cents, which is the rights issue, which when they round off this figure is 23 cents, which is 0.23. So which means if you say 70 million divided by 0.23, rounded off to the nearest million, they got 304 million. So do you see where our figures are varying with the lecturer's figures? But at the end of the day, would not expect the lecturer to penalize you because the difference is there is due to the rounding off. We got 311 million and they are getting 304 million as the rights issue. Why? Because of the rounding off. But remember, they say the rounding differences were allowed for given they were reasonably within the limits and the proceeding steps were correct. So the lecturer is also acknowledging that the answers might be slightly different because of the rounding off. Are we on the same page there? All right. So our rights issue, we are going to be working with 311 million, 111,000, and 111. Next, on the question, they say, calculate the theoretical price per share after the rights issue. And then they say, and the weighted average cost of capital for the company after the rights issue. So they ask us to find the theoretical price per share after the rights issue. And then over and above this, they also ask us to find the weighted average cost of capital for the company after the rights issue as well. And here hint, they say, equity would be theoretical price per share multiplied by the net amount of shares outstanding. So this would be the value of equity. Now, when you go to how we would calculate this, we see that now we need to find out exactly, so how many new number of shares are we going to be having in total? Because remember, the company, if you check on the question, they already told that the company was sitting with 200 million shares, isn't it? And then on the rights issue, we see that we're going to be issuing 311 million shares, 111,000 and 111. So which means when we now find out exactly, so how much is going to be the total number of shares after we do the rights issue, the total number of shares after the rights issue is going to be equal to the company initially had 200 million shares. Then on the rights issue, they issued 311 million, 111,000, 111. Where is this coming from? It's coming from this calculation here. So which means in this case, the new total number of shares for the company is going to be 511 million, 111,000, and 111. Are we on the same page? Are we on the same page there? Now, remember the first part of the question, they asked us to find the theoretical price of the company, right? Then after that, that's when we look at what? The calculation of the weighted average cost of capital. So currently, we are told, if you check on the question, they tell us that the current share price is 30 cents. So currently, the current share price is 30 cents, and currently we have 200 million shares. So which means, in this case, the current market price is 30 cents, and we have 200 million shares, which gives us a current market value of this much. When we do the rights issue, we're going to be issuing 300 million shares at 0.25 cents, which means this is how much is going to be the value of the rights issue. Then from there, it means that the market value of the company after the rights issue is going to be this much amount. Are we on the same page? Now, when you look at the theoretical value of the shares after the rights issue, the theoretical value of the shares after the rights issue is going to be equal to the market value of the company after the rights issue divided by the new total number of shares after the rights issue. And in this case, we are rounding it off to 0.27 cents or 0.27 rand, sorry. Are we on the same page? So if you check on the lecturer's memo, you will see that the lecturer also has 0.27 as the theoretical value per share. So are we on the same page? Any questions? Anyone lost so far when it comes to finding the theoretical value per share? So we can move on. All right. Remember, the next part of the question was to find the weighted average cost of capital. So the next part of the question was to find the weighted average cost of capital. Now, to calculate the weighted average cost of capital, what do we know? Our weighted average cost of capital is given as your cost of debt multiplied by the weight of debt multiplied by 1 minus tax rate, because it has to be after tax, plus your cost of equity multiplied by the weight of equity. Which means the first thing that we need to find out is what is going to be the weight of debt and what is going to be the weight of equity. That's what we need to find out as well. Now, when you're determining the weight of debt and the weight of equity, there are things that we need to take into account. Now, if you check on the question, if the company's policy is to revert to a target weight, so if the company's policy is to revert to the target weight, then the target weights are the ones that we're going to be using. But it has to be stated in the question. And in this case, they don't state that. Are we on the same page? So since the company's policy is not mentioning reverting back to a target debt to equity ratio, what does that mean? The next way of finding the weights is where we now look at what? Using the market values. So we need to find out exactly, so what is the market value of debt? What is the market value of equity? And based on these market values, we can now calculate what? We can now use these market values to find the weight of debt and the weight of equity as well. Are we on the same page?
Yes.
Right. So which means in this case, when it comes to the market value of debt, we're going to say so when it comes to the market value of equity, remember we see that the theoretical share price is 0.27. And how many shares do we have? We have now a total of 500 million shares, isn't it? So the market value of equity in this case is going to be about 138 million. So that is going to be the market value of equity. For the market value of debt initially, if you check on the question, debt initially, we're told that our liabilities were worth 100 million. So if our liabilities were worth 100 million, it basically means that in this case, if our debt was initially worth 100 million, but remember we said from the money that we're going to be looking to raise of 70 million, 50 million is going to be used to retire debt, isn't it? So from the 100 million, we're expecting debt to reduce by 50 million to 50 million. So which means the total market value in this case is expected to be equal to 188 million. Are we on the same page? So which means your weight of equity is going to be the market value of equity divided by the asset value of 188. And to 4 decimal places, you get a weight of equity of 0.7340. And for the weight of debt, if our debt is now going to be 50 million of the total asset value of 188 million, our weight of debt is going to be 0.2660. So these are the weightings that we're going to allocate to the calculation of the weighted average cost of capital. Are we on the same page? Any questions? Now that we have determined the weights, what is the next step? The next step is to find out exactly, so what is going to be the market cost of debt, what is going to be the cost of debt, and what is going to be the cost of equity. So we need to find the cost of debt as well as the cost of equity as well. Now, in determining the cost of debt and the cost of equity, we say now, on the info, I'll start with the cost of debt, which is the easier one. I'll start with the cost of debt, which is the easier one. On the information that they give us on the question, remember, ideally, when it comes to the cost of debt, the most ideal cost of debt that you need to utilize is the market cost of debt. And if you can't determine the market cost of debt, that's when you can use what? The book value cost of debt, right? Now, how you determine the market cost of debt? On the question, if they tell you new debt can be issued at this interest rate, or they can say a bond can be issued at this particular interest rate, that interest rate would be the proxy for the market cost of debt. Are we on the same page? But in our question here, if you check on everything that they mentioned there, they don't tell us any information about determining the market cost of debt. So which means we are not able to determine the market cost of debt. So what is the next thing that we can use to approximate the cost of debt? Use the book value cost of debt. Now, when it comes to the book value, we are going to say, we need to find out exactly currently how much debt do we have? We have liabilities worth 100 million. And currently, how much are we paying as interest? We're currently paying interest of how much? 12 million. So your cost of debt is going to be your interest expense over your total liabilities. So this is what we're going to be using now as a proxy for cost of debt. Are we on the same page? Which means in approximating the cost of debt in this case, we're going to say your cost of debt is the 12 million current amount of debt that we have divided by the 100 million amount of debt. So which means approximately our interest rate is what? 12%. So that's our proxy for our cost of debt. Are we on the same page? Now, when it comes to the cost of equity, what do we see? We see that for the approximation of the cost of equity, we have seen that the capital structure has changed. And if the capital structure has changed, what does that mean? In our approximation of the cost of equity, we know that the cost of equity is approximated by saying your risk rate of return plus beta in brackets, market return minus risk-free rate of return. And here, the market return minus risk rate of return gives you the market risk premium. So this is what we are going to use to approximate the cost of equity. But what do we see? In this approximation, our beta is expected to change. Why? Because our capital structure has changed. Remember, we are now doing a rights issue and repaying some of the debt, which means our capital structure is expected to change. And as our capital structure is expected to change, what does that mean? Our beta is also expected to change. So now we need to find out exactly, so what is going to be the new value of beta given that our capital structure is going to change? So what do we see? Before we go there, if you check in our question, they give us that currently the beta is 1.9, the risk-free rate is 8%, and the market risk premium is 5%. So which means from the information that we have there, we already know that from this information, the risk-free rate of return is 5%. Our beta is going to change, but we already know that our market risk premium, which is this part of the equation, is, the risk rate of return is 8%. Sorry, the risk rate of return is 8%, and the market risk premium is 5%. So now the question becomes, what is going to be the new beta given that we're expecting the beta to change because our capital structure is going to change? And how do we account for this? We account for this using the Hamada equation. So we account for this using the Hamada equation. Are we on the same page so far on what we're trying to do here? So now, to account for this using the Hamada equation, remember we see that currently our beta is 1.9, right? So which means to account for this using the Hamada equation, we're going to say, now, with the Hamada equation, you need to account for the debt to equity ratio. So with the Hamada equation, you need to account for the debt to equity ratio. Now, in accounting for the debt to equity ratio, please take note, you don't use the market values of debt or the target debt to equity ratio. You don't use that. When you're using the Hamada equation, you use the book values of debt and the book values of equity, unless otherwise you're not able to deduce that. Are we on the same page? So what do we see? If you check on our question, if you check on the question, what were we told? Our liabilities, which is our debt, is 100 million, and our equity is equal to 100 million. So currently, our debt to equity ratio is how much? So currently, our debt to equity ratio is 100 million of debt and 100 million of equity, which means our debt to equity ratio is 1. Are we on the same page? Now, after we do the rights issue, what is going to happen? Our debt is going to be reduced by 50 million because we're going to retire debt worth 50 million, but our equity is going to be increased by 70 million because of the rights issue. So if you do the calculation there, you get a new debt to equity ratio, which is equal to 0.29. Are we on the same page there? Any questions? Anyone lost? So with the Hamada equation, the first thing that we need to find is how do we get the beta of the unleveraged firm, which is your BU here. And your beta of the unleveraged firm, so if you check, just to make it a bit more clearer, the beta of the unleveraged firm is given as the beta of the leveraged firm divided by 1 plus 1 minus tax rate multiplied by the debt to equity ratio. So this is how you find the beta of the unleveraged firm. Are we together? So which means if this is the formula, what do we see? Our beta of the leveraged firm, currently the beta is 1.9. We have the debt to equity ratio. We already know that if you check on the question, they tell us that in this case, our tax rate is 27%. So our tax rate is already given to us as 27%. So which means if that is the case, when we go to our calculation, our beta of the leverage firm is going to be 1.9, which is the current beta, divided by 1 plus 1 minus tax rate, multiplied by the current debt to equity ratio of 1. And this will give us the beta of the leverage firm being equal to 1.1. Are we on the same page now? Now that we have the beta of the leverage firm, since the capital structure is now changed, the debt to equity ratio is now equal to 0.29. So what do we see? After that, the beta of the leverage firm, when you just cross multiply it, you make B or the subject of formula. The beta of the leverage firm is given as the beta of the leverage firm multiplied by 1 plus 1 minus tax rate multiplied by the debt to equity ratio. So this is how you find the beta of the leverage firm, considering that now you are acknowledging that there's going to be a new capital structure. So which means in this case, the beta of the leverage firm is going to be the beta of the leverage firm multiplied by, in brackets, 1 plus 1 minus tax rate of 0.27 multiplied by the debt to equity ratio, which we now got to be 0.29. And if you do the calculation there, your beta of the leverage firm is going to be equal to 1.33. Now, if the beta of the leverage firm is equal to 1.33, we can now go to calculation of the cost of equity, because your cost of equity is going to be the risk rate of return. So just to make it a bit more clear as well, now we have seen that the beta of the leverage firm is 1.33. What does that mean? We can now calculate the cost of equity as 8 plus 1.33 multiplied by the market risk premium of 5. So that we're able to get the cost of equity, which we'll plug in here. Are we on the same page? Any questions? So which means in our calculation, it would mean our cost of equity is going to be equal to 14.65%. And if our cost of equity is 14.65%, it means our weighted average cost of capital is now going to be equal to, so now for our calculation of the weighted average cost of capital, it's going to be equal to the cost of debt. Remember, we used the book values of debt, isn't it? We got it to be 12%, multiplied by the weight of debt, which we got to be 0.2660, multiplied by 1 minus tax rate of 0.27, plus your cost of equity, which we did the calculation and got 14.65, multiplied by the weight of equity, which we used of 0.7340. And this is how we would arrive at a weighted average cost of capital of 13.08%. Are we on the same page? Any questions? Anyone lost? If you check on the lecturer's memo,
Sorry, sir, can you please stay on the screen when you are showing us? Yeah.
All right.
Get all the answers. Thank you. Thank you. Sorted.
All right. Now, if you check on the lecturer's memo, the in-between calculations are going to be slightly different because of the issues of that. We remember we have done the number of issues, rights issued there was a little bit different because of the rounding off, isn't it, right? So you see that the values are going to be slightly different. And when you look at the weightings there, they are going to be slightly different because they are using 73, they are rounding it all to 73%, but we are rounding to 4 decimal places. And here the rounding off to 27%, we got 26.660. So the slight difference there is because of the rounding off. And then we use this calculation and you see that because of that, the answer that the lecturer is getting is 13.07%, which is slightly different from what we got, 13.08. The slight difference there is because of the issues of rounding off. Are we on the same page? Moving on to the next part of the question. They also say on part F, calculate the current return on equity and the expected return on equity after the rights issue and compare the two in your own words. So we need to calculate the current return on equity and the expected return on equity as well after the rights issue. So what do we see on the information that we have? On the information that we have, we're given that the earnings before interest and tax is 20 million. Currently, the interest expense is 12 million. So with that information, for the current return on equity, we are going to say, currently, our earnings before interest and tax is 20 million is given. Our interest expense is given is 12 million, which means our earnings before tax is 8 million. Then 27% taxes of 8 million would give you a tax amount of 2,160,000. So which means your profit after tax would be 5,840,000. Are we on the same page? For the return on equity, our return on equity is given as, so our ROE is equal to your net income divided by the value of equity. So our return on equity is our net income divided by the value of equity. So what do we see? If you check on the information that we have, remember, we already knew, we've now calculated our net income, which is the profit after tax in this case, of 5,840,000. Our value of equity, when you look at the book value of equity that we're given there, we're told that equity was worth 100 million, isn't it? So this would mean that the return on equity would be 5.84%. Are we together? Now, when it comes to the expected return on equity, we will see that our EBIT stays at 20 million, but now when we retire equity, what's going to happen? Our debt is going to end up being 50 million. Are we together on how we're getting this amount? Any questions on how we arrive at this amount? So if the interest rate is 12%, so 12% of the 50 million would mean that our interest expense is expected to be 6 million. So 20 million minus interest expense of 6 million would mean our earnings before tax is going to be 14 million. And if you take out 27% taxes, it would mean our profit after tax is going to be 10,220,000. Are we together then? Now, for calculation of the return on equity, our profit after tax is 10,220,000 divided by the value of equity. What do we see about the book value of equity? Initially, equity was worth 100 million. We did the rights issue and we raised another 70 million in equity. So what does that mean? Our equity is now going to be worth 170 million. So which means our return on equity in this case is going to be 6.01%. So which means the rights issue is expected to increase profitability as the return on equity increases from 5.84% to 6.01%. That will be the comparison. Are we on the same page? If you check on the lecturer's memo, If you check on the lecturer's memo, because of the slight rounding off issues there when we do the rights issue there, initially the same amount is the same. Here we got 6.01%, the lecturer got 6%, which is a slight amount. So which means they say return on equity would increase after the change in capital structure. Despite more equity, the drop in interest payments would lead to higher return on equity. So that's basically how the lecturer further on analyzed this as well. Are we on the same page? Part G of this question, they say, briefly argue for or against the rights issue and restructuring plan. Provide at least one real-world example of a company that used a rights issue to raise funds and discuss the subsequent performance of the company to staff your argument. So we need to argue for and against the rights issue. So our argument was, for the rights issue and restructuring plan, the first argument is the rights issue has resulted in a reduction in beta from 1.9 to 1.33, hence reduction in systematic risk associated with the firm, because remember, beta measures systematic risk. So in this case, systematic risk is reduced. The second one is the shares are offered to the shareholders at a discounted price. It represents an opportunity for the existing shareholders to increase their stake in the company at a lower price, thus decreasing the holding price average for the company. And the third argument is the restructuring plan produces interest expense, thus reducing the financial risk associated with the firm. Because remember, we no longer have a fixed interest obligation because we are retiring some of the debt. Then they also say there is an increase in profitability as shown by the increase in return on equity from 5.84 to 6.01. So these are the arguments for the rights issue and the restructuring plan. Are there any questions? So these are some of the points that you can use. Any questions?
Can I just take you back a bit, Rhinos? On question F, no? With the expected, is it expected ROE? So I see there, the interest expense, where it says, is it 15 million times 12%? How do we get to that, or where do we get these figures? I'm a bit lost there.
All right. Remember we said that our approximation of the cost of debt is 12%. Do you remember how we got this amount?
Yes.
Right? Now, we also did the calculation where we said when it comes to our debt, right? When it comes to our debt, initially our debt was worth 100 million, and we are going to retire debt worth 50 million. So our debt is now going to be equal to 50 million. So which means our interest is principal times rate times time, isn't it? The principal amount is how much we're now going to be owing. We're going to be owing 50 million multiplied by the rate, which is 12%. And remember, this is over one financial year. And this is how we're able to determine the interest expense.
Okay.
Yeah. Any other questions? When it comes to arguments against the rights issue, we say, if the rights issue is not taken up by the existing shareholders in proportion and taken up by external investors, this results in dilution of control of the existing shareholders. The second one, issue of new ordinary shares may be seen as a negative signal by investors. Thus, the company's shares are overvalued, which will result in the company's share price falling. The next one is reduction in debt in the restructuring plan reduces the interest, which is a tax-deductible expense, which may in turn increase the tax burden of the company. Because remember, when you pay less in debt, it means we know that debt interest expense is a tax deductible expense, which means you are going to be liable to pay more interest. We are going to be liable to pay more tax as well to SARS. The next one is the cost of debt is less than the cost of equity. The use of the rights issue to pay off debt has resulted in overweighting the more expensive source of capital and underweighting the less expensive cost of capital. We should expect it to increase the weighted average cost of capital, reducing the firm's value. Because when the weighted average cost of capital goes up, the value of the firm goes down. Because remember, we say your firm value is equals to your free cash flow to the firm divided by the weighted average cost of capital. So which means when the weighted average cost of capital goes up, you are expecting the firm value to go down. So that's the next, that was the last argument against the firm restructure in this case. Are we on the same page? So please remind me to share this memo so that those guys who joined us during the revision period, you are also going to be able to benefit from this memo as well, because there is quite a detailed number of points that you can also utilize in case this question comes in the exam as well. So in the next class, we are going to look at question number 2 of this assignment. When we're done with question number 2 of this assignment, hopefully we should have been in a position to get the May-June 2024 paper. If not, I'll come up with another plan. So if not, I'll come up with another plan on another paper that we can also do as well. Then after doing that other paper, we can now go on and review potential problematic concepts as well. All right, enjoy your weekend.